A rail strike that could cripple the U.S. economy is once again a possibility after a second union voted down the proposed contract. And the strike could happen as soon as next month unless all 12 rail unions vote in favor or Congress steps in. Here to talk a little bit more about this and the labor market at large, we want to bring in Tom Perez, American Bridge 21st Century co-chair and former labor secretary under President Obama. Secretary, it's great to see you. So let's start with the rail strike because that's really front and center today. Clearly, stakes are very high right now. The possible strike coming at a time when the economy is already slowing. It seems like a pretty attractive possible agreement here, 24% wage hike, yet that doesn't seem to be enough. I guess from your position as former labor secretary, what do you think needs to happen in order for these two sides to reach an agreement?
I think they'll get there. And, by way of history, I remember when the West Coast ports in 2015 were on the verge of strike. And President Obama dispatched me out there. And there were a lot of predictions of gloom and doom. And we were able to reach an agreement. And when you have so many different unions involved, it's always a challenging process, but I have confidence that they'll get through because there's a real win-win opportunity, really win-win-win, win for the workers, win for business, and win for consumers. And I think there's an acute appreciation that we cannot afford a work stoppage right now. And so I think they will get there. And I've been involved in these dynamics, and it's always darkest before the dawn, and I think they'll get there.
Indeed. And you mentioned the dock workers. They are currently working without a deal. A strike is possible there as well. And Amazon is trying to unionize and Starbucks is trying to unionize. Is this just the tip of the iceberg and a result of this tight labor market?
Well, workers have leverage, and I think that's good. And they're using that leverage. And you see a lot more activity in unionization, whether it's at Starbucks stores or Amazon facilities. I think that's a good thing. And I think you will continue to see workers flex muscle. And you look at the public opinion data, the public opinion of labor unions is at its highest mark in decades. People understand that unions help bring us the weekend and unions have helped bring us shared prosperity. And so you're going to continue to see this across the country. I think it's a good development. And I think unions, management, business, consumers can all succeed together. And that's what we have to do. Make sure that workers who are toiling every single day get their fair share of the pie.
Speaking of workers, the labor market, I want to bring up a letter that Senator Sherrod Brown recently sent to Fed Chair Jay Powell. He sent it earlier this week, coming ahead of the Fed's meeting next week. And in that letter, he wrote, for working Americans who already feel the crush of inflation, job losses will make it much worse. We can't risk the livelihoods of millions of Americans who can't afford it. So, of course, this brings front and center the debate about what the Fed should be doing. Are they at risk of overshooting? I guess now, do you think it's time for the Fed to pause, or what do you think the Fed should be doing at the next meeting?
Right. I hope they don't overcompensate. And when people ask about inflation, inflation is real. I feel it. You feel it. At the same time, remember where we were. I remember when I was labor secretary, and what we saw in 2009 was the stimulus bill wasn't enough. And when I got to the Labor Department, we had millions of long-term unemployed folks, many of whom are 50 and above, less than a college degree, who'd been out of work for a year and a half. And you know what? They were in big trouble. We didn't have to deal with this time because we had a robust stimulus plan. Did it, contribute to some of the inflation? Possibly. But I will tell you, I lost a lot of sleep over the millions of Americans who had lost their job for a year, 2 years, and frankly, were hard-pressed to get it back. We don't have that problem. We don't want to create that problem by overcompensating. I hope the Fed will take that into account in their next meeting.
But, Mr. Secretary, Democrats were fiercely critical of President Trump for criticizing the Fed when he would raise rates. Why is it okay for Sherrod Brown and John Hickenlooper to do the same thing?
Well, I think they're simply addressing a concern that a lot of people have right now, which is that if the Fed takes action, which results in a recession, people are going to lose their jobs.
But doesn't that jeopardize the independence of the Fed?
No, the Fed is going to do what the Fed does, but the Fed doesn't operate in a vacuum. And I look at Senator Brown's letter as simply a plea for them as they make decisions that they're going to be making to understand the doctrine of unintended consequences. I don't see that as exercising undue influence. He's not saying if you do this, we are going to do X. He's just saying, please remember, please look at history. Please don't overcompensate.
Yeah, and I think it is raising some eyebrows, obviously, given the time of it, the fact that we are only 2 weeks, less than 2 weeks until the midterm. So speaking of midterm, Secretary, I want to get your thoughts just on the messaging that we've heard from the White House, because today, pivoting once again, focusing on the economy. And over the last several months, I think the feeling out there is that the messaging from the White House has been very mixed. I guess, first off, what do you think the messaging should be or needs to be over the next 2 weeks?
We have your back. We climbed out of this pandemic. We've created 10 million jobs under Joe Biden. We had the quickest recovery from the pandemic in U.S. history. We see manufacturing moving at a wonderful clip. Look at the investment in the CHIPS Act. A company in New York announcing a multi-billion-dollar investment. We're bringing down the cost of prescription drugs. We are working on the issues that matter most to you. And we are protecting a woman's right to choose. These are the pocketbook issues. These are the issues that people are thinking about. And that's why, in a normal midterm environment, we'd be prepared to get shellacked. But this is the most fluid environment I've ever seen. And it's fluid because we have put points on the board. We have been fighting on the right side of issues for people. And we've got to make sure that voters understand that as they head to the polls.
But the singular issue that you hear in poll after poll after poll that matters to Americans most is inflation. And it is still out of control. And that's why, or part of the reason why this NBC poll found that Americans trust Republicans on the economy 20% more than Democrats. So will that message from President Biden sell?
Well, we're going to continue to make sure that people know the facts. I mean, the Republican response to today's challenges is let's cut Medicare and let's cut Social Security. Those aren't my words. Those are things that Republicans like Ron Johnson have proposed. I don't think that's going to help people in any way, shape, or form. And so, we're now at the stage of this campaign. It's about turnout. We have election after election. We could go over Wisconsin, Georgia, Pennsylvania, et cetera. We've got all these elections that are razor thin. And I think in the end of the day, we are going to surprise so many people because we saw in those 5 special elections post-Dobbs, Democrats doing well, and not just in blue areas, but in places like Kansas. And so this is a turnout election, and that's what Democrats are doing, and they're doing it well. You see the early vote numbers in a number of states are, frankly, eye-popping. I think Georgia is going to exceed their 2020 early vote numbers. And so it's going to be razor thin. We're swimming upstream against historic tides in midterm elections, but notwithstanding that, we're very much in the ballgame because we have put points on the board, and the president deserves a lot of credit for what he has done.
We'll see the outcome in just 12 days from today. Secretary Perez, always great to have you. Thanks so much for joining us.
My pleasure. Have a wonderful day.
All right, well, coming up next, with mortgage rates above 7% and new home sales slowing, we will speak with the chief economist of the Mortgage Bankers Association, get his forecast on the housing sector next.
Last time mortgage rates were north of 7%, the first Spider-Man movie had just debuted in theaters. 8 films and 3 Spider-Men later, the 30-year fixed is back above 7 to 7.08%, up from 6.94 last week and 3.14% just a year ago. That's according to Freddie Mac. Let's talk about the housing picture with Mike Fratantoni, Chief Economist and Senior Vice President at the Mortgage Bankers Association. Good to see you, sir. So where are these rates headed? Will we see 8 before we see 6?
It's a good question. And I would say one of the prime features of the market today is just an incredibly high level of volatility. Rates are bouncing around like crazy. So if you look at the 10-year Treasury today, it's down about 40 basis points from a recent high. And that tends to be a benchmark that mortgage rates track pretty closely. So day to day, it's unclear where we're headed. But I think over the next 6-12 months, we're likely to see mortgage rates lower than we see them today.
How much lower, Mike, do you think?
So our forecast is probably back to about a 5.5% rate. So I don't see any way we get down to the 3% rate we had in 2020 and 2021. But 7% is really unsustainably high as well. And we think there's 2 forces out there. The Fed is pushing up short-term rates to try to combat inflation. But on the other hand, we're forecasting a recession for next year. And there's a lot of global weakness that's going to be putting some downward pressure on longer term rates. And that'll really be helping to bring mortgage rates back down to a more typical longer rate.
So how would you characterize the impact of these higher rates in terms of how they have hurt the housing sector? And let's push towards 23. What will happen to home values?
Yeah. So really beginning this spring, sort of late May, June, it was just sticker shock. We saw borrowers that were looking to buy a home, their mortgage payment was $400 or $500 more than when they first sat down to come up with a budget for that home purchase. So people just backed away. But I think as we get into 23, again, we have the challenges coming from a weaker economy and likely a rising unemployment rate. But then the benefits of, we think, mortgage rates drifting lower. And one of the biggest challenges home buyers faced the last couple of years was just the lack of inventory on the market. We think it'll be a little bit easier to find a home in 2023. There will probably be fewer situations of that multiple bids above list price. And I think for that, particularly that first-time buyer, it'll be really more thoughtful exercise. You won't have to make the offer the minute you see the home. You might actually have a little time to think about it. But from a housing market and mortgage market perspective, it'll be a slower market in 23 than we had in 2022. We think mortgage originations are going to fall about 9% in 2023 compared to what we saw this year. And this year, volume is about half what it was last year.
Wow, a huge drop expected there into 2023. So given that, then we've already seen a number of layoffs within the mortgage industry. I guess, how do you see that playing out then if you're expected it to slow down even further next year? How many cuts could we potentially be looking at?
Yeah, so in the mortgage industry, there's the 2 types of loans getting made, right? There's refinances, which are entirely rate dependent. Those have just shut off this year. We're down more than 85% in terms of refinance loans compared to last year at this time. Purchase loans have also dropped again due to the sticker shock phenomenon. But we have an estimate that peak to trough, with the peak being in late 21, the trough being in early 23, the industry is probably going to lose 25 to 30% of employment. And we're probably about a third of the way there so far. So you're still going to see additional layoffs and some consolidation in the sector.
And that is part of the Fed goal, of course, is not just bringing down home values, but of course helping out with the labor market as well. There are many that fear the housing sector could be the one thing to break because it is the first one to feel the pain. How concerned are you?
Yeah. So you look back at business cycles over the past several decades, you regularly would see the housing market weaken first when rates first went up. But by the other end of the token, we expect the housing market's going to rebound first as well. So I think the recession will probably be in the first half of 23, but as rates drop, buyers re-enter the market. We expect we're going to see housing lead the economy out of recession as we get into the second half of 23.
So then, Mike, speaking to that, I guess comparing the situation that we're in right now to what we saw back in 2006, 2007, 2008, and I bring that up because of the delinquency rates. And I know it's something that you are tracking very closely, but where we are today, it's not too far from that record low that we set in May. So what does this tell you just about the comparisons that some people are drawing to today to what we saw about 15 years ago?
Yeah, I would say it's night and day, right? 2006, 2007, you had a housing boom like we'd never seen before. You saw very loose mortgage credit, and you saw really an abundant supply of homes on the market. Coming into this, housing supply was really quite tight. Credit criteria are extremely tight, both because of what lenders are doing, and then really some of the regulations that were put in post Great Financial Crisis have really locked in really traditional underwriting and sound credit behavior. So I think the housing market is in relatively good shape. And again, the undersupply is a real critical factor here that is going to prevent home prices from really dropping the way we did see during the Great Financial Crisis. And I think it's also going to lead to a rebound as we get past this period of weakness and as mortgage rates return to more typical levels.
Yeah, certainly a very different situation what we were looking at in the last recession, right? Mike, Fred, and Tony, great to have you. Thanks so much for joining us. Another story that we are following, the popularity of the I-bond. The Treasury Department says that it cannot guarantee I-bond orders will be processed in time for tomorrow's deadline. The government's website is experiencing intermittent outages due to that high demand. Investors are running to purchase the series I-bonds, currently paying out a 9.62% interest rate. The rate is set to drop to about 6.5% on November 1st. The Treasury issued nearly $2 billion in the bonds just this week. That's according to the Journal. That's more than the total number sold during fiscal year 2021. If you still want that 9.62% rate, you must complete the purchase and get a confirmation eval by tomorrow, October 28th. All right, well, coming up, McDonald's earnings beat analysts' expectations, thanks in part to some funky Happy Meal toys. How adult Happy Meals boosted their bottom line next.
information.
It's time for Triple Play. 3 stocks that we're watching in the final 30 minutes of trading. We have Shopify, ServiceNow, and McDonald's. My pick today, Shopify. The stock is soaring after beating on revenue and reporting a narrower loss. You can see the jump of just around 18%. That is the biggest intraday gain that we have seen in about 5 months, despite a slowing economy, stronger dollar. Sales during the quarter jumping 22% from just a year ago. Now, the e-commerce company has made some big changes amid that tougher macroeconomic environment, including cutting 10% of its workforce, rolling out a new compensation framework, and also integrating shipping logistics company Deliverr into the platform. So, Josh, when you take a look at the share jump today, yes, good news here, but that year-to-date chart, you can see still severe losses. The company has a ways to go in order to gain back, I think, Wall Street's trust.
Oh, absolutely, Shauna. And I mean, it was a stock that people loved during the pandemic, right, because of their e-commerce success. But now we're seeing them kind of come out of e-commerce a little bit. So one analyst today on the street pointing out, you can see kind of what they're doing from a retail side now. And I think that's going to be interesting to watch for Shopify as a payment platform, kind of more akin to what PayPal does and something that you use online, but then you're also using when you go to the store. I think that's going to be an interesting story to watch. I also have some earnings to take a look at here. My play is ServiceNow. Shares of that software as a service company are soaring today, up about 13%, as the company beat Wall Street estimates on earnings per share by 12 cents. And projected fourth quarter revenue will grow between 20 to 21% from the same quarter last year. Now, ServiceNow CEO Bill McDermott told Yahoo Finance earlier today his company's service is a, quote, once-in-a-generation deflationary force, citing its strength against the current macroeconomic headwinds. And Dave, I mean, the street loves this stock, currently 36 buy ratings, 1 hold and 1 sell. And I wanted to point to what one of those analysts said today, upgrading the stock to outperform at MoffettNathanson. And what he highlighted, he said that, is this where mega cap investors should be looking? And he said after Microsoft yesterday, kind of disappointing in the software as a service space, is it a stock like ServiceNow that people should look at instead of those big FANG names, maybe a little bit more growth opportunity
It's
here?
hard to argue against that logic.
Right.
And I am buying Bill McDermott. I read through the transcript, right? And let me just give you another little gem from this. I feel like I need to stand up, okay? This is Bill just breaking it down. We could do it because ServiceNow was born in the cloud. We integrate with everyone. We meet our customers wherever they are, any environment, any organizational structure, any operating model. Where there was complexity, we simplify. We are fast to deploy, fast to generate return on investment in this need for speed environment.
Now, ServiceNow, Dave.
The ServiceNow platform is becoming the strategic center of gravity for our customers. Bill
There
McDermott.
we go. You said it perfectly. Almost, maybe
Bill
even better than
McDermott.
Bill himself.
Wow.
It's a company ready to grow.
That, my friend,
We're
is
even
the
sweating a little
transcript.
bit after that
All
one.
right, anyway. My play is less inspiring. It is McDonald's, who shares up on the heels of a solid Q3 earnings beat. Worldwide, the company's same-store sales climbed 9.5%, handily beating estimates of 5.8%. Their CEO, Chris Kempczynski, saying business is strong despite recessionary fears. Quote, there is increasing uncertainty and unease about the economic environment. The burger chain says it raised prices on average 10% in the third quarter and expects increased costs for food, materials, and labor through next year. And for the current quarter as well, promotions helping drive traffic this month. It's the adult Happy Meals. Half of those cactus plant flea market toys that were sold sold out within days of its debut. Shares of McDonald's up over 3% on this news. They are recession proof, it would appear.
They seem to be, and that's what analysts are saying now in the wake of these results. They are starting to call McDonald's a recession proof play. You mentioned the popularity of some of those adult Happy Meals toys. One was listed for $300,000 on eBay. I don't think they necessarily got
Listed.
that $300,000,
Right.
but still it
That's
shows
the
that there is a
listed.
lot of appetite for them. Some of them were going over $1,000. I don't think anyone necessarily would have expected that.
Right.
Now they have the McBoo bucket that a lot of parents are very excited to get their kids so they can use it for trick-or-treating.
Krispy Kreme coming up as
Krispy
well.
Kreme
The
coming up,
McRib?
lots
The
of
McRib?
menu
The
innovation.
McRib coming back
McRib.
on Monday.
And also, it's not just excitement here in the U.S. Their international sales were over 8% and much better than expected during the quarter.
Right, that was really stood out among
Yeah.
this report despite all the struggle there, and that's what tells you they really are recession-proof.
Right. Well, it makes sense, right? If people are going to kind of downgrade in terms of eating out and go and do something different and they still need a quick meal, you're going to go to a place like McDonald's, and they're bringing innovation with the McRib. Are you a McRib fan?
No. You?
He's not even a Big Mac fan.
No. The McRib, the texture.
I've
man.
never tried a McRib. I'm not.
Sounds like a taste
I might
test.
be willing to try it. Maybe we should do a taste test. That could be good.
You're off on Monday when they
Tuesday.
debut,
So
but Tuesday it is.
Maybe.
Josh, good to have you here, brother. All right, coming up, Elon Musk making his pitch to Twitter advertisers. How advertisers are viewing the acquisition. Coming up. Top of your Musk Minute. Elon making his pitch to Twitter advertisers a day ahead of an October 28 deadline to complete his $44 billion deal to buy the platform. You can see shares up just over 1% at the moment. Musk writing an open letter saying this, in part, quote, Twitter aspires to be the most respected advertising platform in the world that strengthens your brand and grows your enterprise. Joining us to discuss is Ari Lightman, Digital Media and Marketing Professor at Carnegie Mellon University's Heinz College. Good to see you, sir. So can you do that? Can you aspire to be what Elon just did there and do the other things he wants, which is, you know, bring more voices back onto the platform, some of which are very divisive?
It's really difficult. You have to build trust. And trust is really hard in an age where we have a lot of misinformation, we have a lot of brand hijacking, and things can get away from you very, very quickly in social media, as a lot of brands know. The last thing any brand wants is a mismatch associated with its brand identity and its brand values, and misogyny, misinformation, hate speech, anti-Semitism, which can widely circulate in a social media platform that's uncensored and unchecked.
So Ari, then how does Musk then best approach it? If you were advising him right now how to build the relationship with advisors, how to build that trust, like you just said, what are one or two steps or things he can prioritize in order to gain it?
That's a really good question. Lots of openness, lots of experimentation. A lot of social media platforms, when they hide their algorithms from advertisers, and their ad messages don't show like they hope they would, or present themselves to different communities that they're trying to attract through these social platforms, they lose trust in the platform quite a bit. And they look for other avenues. And there's plenty of other avenues where they could spend their marketing dollars, whether it's TikTok or Snapchat or what have you. So he has to make sure that he understands their needs and understands some of their concerns and how he's going to address those concerns associated with operating the platform. It's a really new space if you think about it.
Yeah. This letter is a true gem. He says, Twitter cannot become a free-for-all hellscape where anything can be said with no consequences. He also says our platform must be warm and welcoming to all. How would you describe the platform today, and how do you think it's perceived by advertisers?
It's a tricky platform, right? There's a lot of snark. There's a lot of cynicism, right? There's a lot of skepticism. There's a lot of sort of folks that gravitate very quickly to a lot of Twitter influencers that we know of, right? So communities get built and they evoke a lot of pull and a lot of sway. Understanding this and addressing this in conversation is critical, right? There's a balance, if you will, between this idea of heavily moderated, heavily censored, and an open platform. Both can exist to some capacity, right? But being very genuine, if you will, in terms of why they're doing more of this idea of openness is critical to get them to understand how the platform will help sort of build their brand, be authentic to the brand that wants to advertise on it, and allow them to do specific initiatives, whether it's more awareness, whether it's community building, or whether it's attracting new audiences associated with that brand.
All right, how do you think advertisers perceive a potential conflict of interest, being that Elon Musk isn't just the owner of Twitter, he is the owner and CEO of Tesla that has zero advertising budget? Could that be an issue?
Absolutely. So, you know, some of these in and of themselves, so in the case of Elon Musk and Tesla, there's two brands there, right? There's the brand of Tesla and the brand of Musk. And he integrates the two of them incredibly well, and they're very valuable properties in and of themselves. I think he's going to have to answer that question to advertisers associated with the fact that Tesla doesn't have that marketing budget that they expound. But if Elon Musk wants to do it adeptly, helping advertisers understanding influence within the space, right? How to create it, how to develop it, and what that means when you think about persuasion, when you think about motivation, those sorts of things. A lot of brands that we work with at Carnegie Mellon are trying to understand that analytically, right? Which influencers do we pay attention to? How do we get them to sort of help in terms of spreading awareness associated with what we stand for, the mission associated with our brand, whether that might be sustainability or whether that might be performance and activation and consumer response, those sorts of things. Elon could probably run a class on this, but how he helps advertisers in terms of understanding the uniqueness of social media and the uniqueness of social influencers might be very critical associated with getting them to trust advertising within the platform.
All right, Lyman, great to get your perspective on this. Certainly, we will see how this all plays out. Thanks so much for joining us. All right, take a look at shares of Twitter right now because you won't be able to check them for much longer. Reports say that the stock is going to be delisted ahead of the open tomorrow as Elon Musk's $44 billion deal to acquire the social media giant is on track to close tomorrow, meeting the court-mandated deadline, but it may not be gone for too long. There's a separate report out there saying that Musk is looking to bring Twitter back to the public market in 3 to 5 years. And you see that 1 month chart The stock has jumped pretty significantly, up 27% today, trading at $53.82 a share. All right, coming up, women are switching jobs at record rates. Find out what women are looking for in employers when we come back.
A mass exodus of female leaders is upon us. New research from McKinsey shows senior managers, vice presidents, and those in the C-suite leaving their jobs at the highest rate ever, 10.5% in 2021, more than double the 9% of male leaders leaving the workforce. And women leaders are switching jobs at the highest rates the survey has ever seen. Jennifer Schwab is the CEO of Entity Academy, who joins us for today's installment of Career Control, brought to you by Straight Talk Wireless. Nice to see you. Why, in your estimation, are women leaders fleeing the workforce?
Well, some of it's nothing new. The studies, the McKinsey study's been out for 8 years, but we are seeing some of the same old things. Microaggressions, especially as you're ascending in the workforce, sometimes they apparently get worse. We are also seeing that women are feeling like they're undermined as they're advancing, and they're being passed over for promotions. And in a lot of ways, that's like a vicious cycle, because if we don't get women into senior leadership roles, there's far fewer to choose from to end up in the C-suite. And so in our estimation, things have gotten maybe a little bit better. We focus on STEM. So the numbers are creeping up for women in STEM, but overall senior leadership roles for women, it's still not good enough.
So Jennifer, you mentioned STEM there. You mentioned that it's getting a little bit better. I guess, what are you noticing that's working? How are you getting more women into STEM and then staying in the workforce?
Yeah, that's the challenge. I think there's been progress on getting women to pursue STEM careers, but it's retaining them. Accenture put out study that said 50% of women that are in STEM careers actually leave them by the time they're 35. So I think we're getting people excited about STEM, but the retention issue still needs to be addressed.
Why are they leaving, and how do you get them to stay?
They, like I said, they leave for a number of reasons. Feeling undermined, I can be very demoralizing. Feeling like, okay, I've done all the right things. I've put my life into this company, but I'm still being passed over. And, perhaps if I go to another company, I can advance faster. That's one of the reasons they're also leaving. And I've seen this play out at Entity with a number of our mentors that are in senior management roles, where they see the glass ceiling. They say, okay, I can go somewhere else to actually get the promotion I deserve here.
And a lot of that points to the gender pay gap and what we've been seeing on that front. Have we seen any significant improvement there? And I guess, how has COVID maybe stifled some of these step forward that we did make prior to 2020?
Yeah. So in terms of closing the gender pay gap, I think that, wages got better when the workforce was very tight. Last year, when you saw that there was the Great Resignation, companies were starting to pay more to recruit and retain talent. And now, as we're entering this recession, things are starting to reverse again. And it's really disappointing because many companies are saying, okay, I want to find somebody who's already been in this discipline and can hit the ground running day one because I have a limited budget of who I can hire. So they're not as focused on diversifying the workforce as we're entering into a recession.
Good stuff there. Entity Academy CEO Jennifer Schwab, appreciate what you're doing and coming here to talk about it. Thanks. Coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live.
Counting down to the closing bell, Jared Blickery's at the big board with some of the moves that we're seeing. What do you got, Jared?
Well, we're all awaiting Amazon and Apple earnings after the bell, but let's just focus on Meta one more time. Down 24.5% here. Now, on a market cap basis, we are now looking at a $263 billion handle. I remember when Meta used to take up all of this space. Here was Nvidia, here was Tesla. Now we got this little quadrant down here, something to consider. Want to take a look at the price action in the sectors today, and let's get it back to a percentage basis. There we go. Industrials, financials, utilities, energies, and now staples all in the green, mainly favoring the value trade here. Let's take a look at what's happened over the last 4 days. Pretty similar. Industrial, staples, financials, real estate, utilities, all of those outperforming. Now, if we take a look at the Nasdaq, going to be a much greener picture, except for a lot of those mega caps. And that's where we've seen a lot of the price action to the downside this week. So I'm going to put this back on our intraday, and let's go to our meme stocks here. We haven't added Meta or Credit Suisse to this list just yet, but this is another area where we've seen pockets of strength during the week, but not so much so today. Got to show you the travel sector with about 18 seconds left here. We got Avis Budget Rental Group, that's up 3%, Hilton up 2.5%, United up 1%, and here is your closing bell.
All right, there you go. Your closing bell on Wall Street for this Thursday. Let's check out how the markets closed. Up about 200 points on the Dow and some red the rest of the way. The S&P drops about 23 points, and the Nasdaq continues to fall. Been a rough go thus far for big tech, falling 1.6%, a drop of 178 points. For a closer look at the markets, let's bring in James Slew, Clearnomics founder and CEO, and Michael Landsberg Bennett, Private Wealth Management Chief Investment Officer. Nice to see you both. Michael, we'll start with you. What are you learning in this market the last couple of days?
I think what we're seeing is earnings aren't particularly good. A lot of people are talking about beating expectations, but 180 stocks so far have reported roughly of the 500 S&P. Earnings growth is negative 3% year over year. Even great names like McDonald's, they beat expectations, but in reality, they did $2.86 a year ago. They did $2.68 this quarter this year. It's deceleration in earnings. It's something that we got to keep an eye on.
James, what do you think? Here we are looking at a day where we're seeing a bit of mixed action. Dow holding on to gains. S&P still above 3,800, but ending the day in the red. I guess the moves that we've seen over the last couple of weeks since we last spoke, have they made sense to you? And what does that signal?
Yeah, well, Shauna, basically you are seeing this divergence across sectors and across major indices. Obviously, tech is dragging things down right now as we speak. Those earnings are being hit hard. But when you look at overall earnings, those are coming down a bit because of the sluggish economy. But earnings estimates are still around $220 for full year guidance. Now, again, those will probably come down a bit. They're probably a bit too lofty. But even if they come down, and we're talking about 8% earnings growth, that's still actually quite strong. So it really depends on the specific sector and the overall market that we're looking at. But then it becomes a question about the Fed, and that's where today's GDP report was strong. So, basically, we're going to have to look very carefully at the earnings numbers over the next couple quarters to see if the earnings guidance that we're seeing right now does play out.
Yeah, and Michael, you mentioned your thoughts on earnings thus far. What does the GDP number up 2.6% tell you is coming?
I think it tells me the Fed, this idea of a pivot's not going to happen. Fed's been raising rates, and the GDP, hasn't really gone down. It's been able to grow this quarter. We expected a little bit of growth this quarter. I think the kind of the heavy stuff happens fourth quarter and first quarter. But the idea of a pivot here, I think, is crazy to me. I think people are rallying the market thinking this is not going to happen. But I think the Fed to go up quite a few times. They'll be higher than many people want. And I think you need a position for that.
How aggressive, Michael, do you see the Fed potentially getting then?
I see at least the next three meetings. Obviously November, December, and then obviously late January, February. Just because I think what they're seeing now is it really hasn't hurt. Unemployment's still very strong. GDP numbers here are strong. So I think their goal is, and Powell seems like a student of history. When I look back to the 80s, Volcker raised rates a lot to get it above, Fed funds were above CPI. And I don't know if we have to get there, but we certainly, I think, are in a spot where they're going to continue to raise. ECB raised 75 basis points this morning. I think it's basically full raises ahead. Again, I'm not saying I want that, but I'm looking at what's happening. I think that's what we're going to see.
James, your thoughts on the next three meetings continuing the Fed hikes?
We do think that the Fed is going to have to continue to hike, not just because that is the path they're on, but also because inflation not only hasn't come down, but it's gotten worse. And even if it does come down, it's going to take a while for it to get back to even anywhere close to the Fed's target. So, you look at today's GDP report and it's positive, but of course, good news is being interpreted as bad news in the market. But what the GDP report really tells us is that it is not inevitable or unavoidable to have a hard landing. It is possible theoretically to strike some sort of balance here. And really, that all that means is that the Fed is probably going to keep raising rates until we do see unemployment start to tick up, until we see growth start to slow a bit further. But it's also possible that many sectors still continue to outperform in that environment.
Michael, where are you seeing the most opportunity, just given all the volatility that we have been seeing? We're waiting for Intel, Amazon right now. Given the losses that we've already seen in the tech sector, is there an opportunity to buy there?
In tech, no. Yeah, to me, it looks like tech is the area that will continue to be, I mean, again, had the best gains the last 3 years. It's going to suffer the worst here in an environment where there is some deceleration. Certainly seen it across the board with some of the ones that have already reported. I think you want to stay out of that space. I think you want to look at healthcare, things that do well in a recession. Healthcare, staples, and particularly like discount stores and utilities. I'm still a fan of the U.S. dollar. And I think that's the places you want to be. Again, at some point, there's some good tech companies, maybe one-offs, but as a sector, they've had great runs. I think they're going to give a chunk of them back and continue to do that.
James, are we anywhere near a buying opportunity in big tech? And what are your expectations the rest of the way? We've still got the Apple and Amazon numbers coming out here any minute.
Yeah, so we generally would prefer the consumer sectors a bit more. Those sectors are challenging because obviously inflation is hurting consumers and the housing market is going to hurt households. However, you look at the earnings growth that we're seeing in those areas, and that's still a bright spot in this economy. And so although there's going to be challenging times in the consumer sector, that's really what we prefer. Tech, we would still be in a holding pattern here. There are just too many things playing out, especially very stock specific, non-macro activity that's happening that's affecting those stocks.
Okay, got to leave it there. Got some news coming in. James Liu, Michael Landsberg, thank you both. Appreciate that. We got to get to Amazon earnings. They are in. Ali Garfinkel is going to break them down for us. You can see stock moving at this hour. What are you seeing, Ali?
Yeah, Dave, Amazon shares are tanking on results, down almost 20% after hours. And this is mostly on Q4 net sales guidance. It was a pretty big miss. They're guiding to 140 to 148 billion instead of 155 billion. And the numbers coming down for today for this quarter are not what they hoped for either. Revenue was a miss. It came in at 127 billion versus 127.6 billion expected. Adjusted EPS was a beat, came in at 28 cents actual versus 22 cents expected. And Amazon Web Services came in just a little bit short, 20.5 billion rather than 21 billion. And what's going on here, Dave, is they're saying they've been hit by the macro environment. They're working on improving fulfillment, but this is not what they were hoping for today.
Certainly is not. Ali Garfinkel breaking those Amazon earnings right now, and you can see shares plummeting 17% after hours. Shauna, the big tech, big rout just continues. The macro environment just looks awful, even for Amazon.
It does, even in the retail space, which Amazon obviously focused into, as well as cloud, the AWS miss that Ali just mentioned, obviously a huge reason why we're seeing such significant losses, coupled with the light guidance that we've seen, again, off just around 17%. Taking a look at some of these other numbers here, or what they also said in this release, saying the unfavorable impact on revenue of 460 basis points from FX. We've been tracking the strong dollar, what this means here for a number of tech companies over the last couple of quarters and what it could mean for the current quarter. We know that guidance for Amazon is so important given the holiday quarter, what we are in right now. So the fact that that came in weak and pretty significantly, they're expecting 140 to 148 billion. The estimate out there was for 155 billion, Dave. So obviously a huge miss there, and that's why we're seeing the stock off just around 17%.
Any good news stand out to you at all in this report? I'm searching for some, but I'm not quite seeing any. It kind of echoes the Jeff Bezos batten down the hatches remark that we heard, what was that, a couple of weeks ago?
It does. Certainly a slowing economy. I guess if you want to point to some good news, that EPS beat of 28 cents, the estimate was for 22 cents. That's obviously better than expected, but we're really seeing that guidance. That's really the narrative here, and that AWS miss. So I'm certain that analysts will be looking for more information on that on the call, and we will be getting analyst reaction in just a few minutes. All right, I want to turn to Intel. Intel is out with its earnings report and taking a look at how shares are trading. Look at that, a bit of good news here in the tech sector, up just around 2%. Taking a look at some of these numbers, third quarter revenue of 15.3 billion. That was basically in line with what the street was looking for. EPS, a big beat there, 59 cents. The estimate was for 33 cents. Fourth quarter revenue and profit and revenue guidance coming in just a bit light. Their full year adjusted revenue also missing the street's expectations. Intel, though, highlighting cost-cutting measures, what they're planning to do in 2023. Maybe that has the street a little bit excited there. They're looking to cut $3 billion in costs next year, saying that they are aggressively addressing some of those issues, some of those cost issues. So again, revenue basically in line, a big beat on EPS. We're seeing the stock up just around 2% here in after hours. All right, coming up next, Amazon shares once again sinking after hours, off nearly 20% following that poor fourth quarter guidance. We'll get analysts to take next. Take a look at Amazon. Look at that, off just around 18% following their earnings release. Fourth quarter guidance coming in a bit light. Also, AWS revenue there during the quarter, $20.5 billion, missing the street's expectations for $21 billion. Here to break all this down, we want to bring in Arun Sundaram. He's CFRA's analyst. And Arun, when you take a look at the results that we just got, taking a look at the reaction in the stock, off just around 18%, what's your takeaway?
Yeah, I mean, I guess we shouldn't be surprised to see some, big tech sell-off. It seems like when companies do miss these large cap names, we're seeing large sell-offs. We saw that earlier today with Meta. But the big theme here, I think, for the sell-off and after hours is the guidance. The guidance was, especially the sales guidance, was well short of consensus. Amazon's guiding for Q4 sales of 140 billion to 148 billion. Consensus was around 155 billion. So that's about 5 to 10%, short of consensus there. And even on the bottom line, the guidance for Q4, they're looking for between $0 and $4 billion of operating income, and consensus was about $5 billion for Q4. So I think this reaction is really based on the weak guidance, and it's due to these macro factors that we've all been talking about. A softer outlook. And now it looks like, we knew Amazon's e-commerce business was slowing down, but now we're also seeing that trickle into their AWS business, which has historically been the much faster growing cash cow for Amazon. So we're now seeing, AWS slow, which is similar to what I think Microsoft reported earlier this week. They saw a similar effect as well.
And that's what I want to ask you about the AWS number. That's largely been the investor story for quite some time, far more so than the retail business. What does it tell you that that number disappointed?
Yeah, I think we have to listen to the analyst call later today. But I think the reason for that slowdown. So if you look at operating margins in AWS, it was 26.3% this quarter. The consensus was about 29%. And I think the big culprit there might be due to higher energy costs. To power these AWS servers, it's a lot of natural gas, electricity. I think that's a big culprit there. And also, I believe stock-based compensation was higher than expected. Amazon's it's having to pay a lot to hire and retain a lot of their engineers in their AWS business. So I think the combination of higher energy costs and higher stock-based compensation was really the reason for that margin hit in AWS.
What do you think this means just in terms of the pressure that CEO Andy Jassy is going to be under to further cut costs? Do you think he's going to have to face a little bit more on that front because of these results?
Yeah, certainly. This has been a talking point at Amazon for the past several quarters now. Mm-hmm. Like I said before, we knew demand was normalizing, especially in the e-commerce business. And the goal for Amazon this year was to really cut down on their fixed costs and really right-size their capacity to match these new demand trends that they're seeing. So in that sense, even though revenue growth will slow, it shouldn't have a major impact on margins because they're focusing on their cost structure and cutting expenses. So I think that's going to be something that Amazon will continue to work on throughout 2023. I think now we're going to maybe see some cost cutting in the AWS business, since it does look like revenue growth is slowing in that business as well. Previously, we really saw most of the cost cutting in the e-commerce side of Amazon, but now it looks like they might shift that playbook to their cloud business as well.
It's largely been the Andy Jassy narrative, trying to undo some of that spending and massive growth under his predecessor and cut his way to some wins. Look like there's some more ahead. Not a huge part of the investor story, but the streaming aspect of it, subscription services, certainly gets a lot of ink. And it's interesting to see that number disappoint as well. Again, a lot of attention on Thursday Night Football and Lord of the Rings sequel. How disappointing is that?
Yeah, the subscription revenue came in at 8.9 billion. Consensus was around 9.2 billion. We also projected around 9.2 billion of subscription revenue growth. And I think you also have to lump in advertising into that. Advertising is a growing part of their business, especially as they grow out their, Prime Video streaming service. Yeah. At least on the advertising side, that did beat consensus slightly. We saw about 25% growth in advertising. Consensus with 24% growth. We actually thought they would grow their advertising business by 35% this quarter, so slightly below our expectations. And really, the reason why we think advertising is poised to growth for Amazon is because Amazon was historically a major e-commerce advertiser, but now they're really shifting gears and becoming a major video advertiser with the growth of their Amazon Prime platform. We're seeing all this new Amazon Originals. This highly anticipated Lord of the Rings series got released in September. Thursday Night Football. These are, these programs cost Amazon a lot of money, and they're hoping that turns into really strong growth in their advertising segment and also their subscription segment. So yeah, we did see some weakness or some weaker than expected results in subscription and their subscription segment, but I think that made up for it a little bit on their advertising side.
So I guess how much of this is really a timing issue? And then when we look ahead to the call that's going to get underway, what's the number one thing that you want to hear from management?
Yeah, the number one thing I'm going to be looking out for is how are they going to continue to right size their capacity to match these new demand trends that they're seeing. Amazon is a company that runs on a heavy amount of fixed costs. So you need these fulfillment centers and warehouses to really run on optimal capacity to generate strong margins. And right now we're not really seeing that. So, we're going to be looking for, things that Amazon are doing to, cut future projects, cut CapEx spending, especially among their fulfillment network. If you think of how much Amazon has invested in their fulfillment network over the past 2 years, it's incredible. And now I think the goal is to cut back on those expenses and allow Amazon to grow into that overbuild that they created over the past 2 years.
Can they cut their way to some wins? A rough report for Amazon. You can see shares down about 19% after hours. Aaron Sundaram, thanks so much for being here. Appreciate that. Coming up, Intel moving after hours as well. You can see it up. There's some good news, up 7.3%. We'll take a closer look at the chip giant's quarterly earnings next. All right, Intel moving up 7% after reporting Q3 earnings. We have Matt Bryson, Wedbush Securities Senior Vice President of Equity Research and Hardware, with us for more on the chip maker. What are you seeing? What's your reaction to Intel's report?
Honestly, I'm a bit surprised the stock's up. The report was fine. They did better on the PC segment than I'd been expecting. And expectations were clearly low heading into the print. But again, they had to take guidance down for Q4. Last time they talked to us, they were talking about Q3 being a bottom, them taking some inventory out of the system, and then things would pick up again in Q4. And instead, they've guided for Q4 revenues to decline, gross margins to come off. So clearly Q3 wasn't the bottom.
When do you expect to see a bottom, I guess, when you take a look at this stock? Because we heard from Gelsinger, he wanted it to be in the third quarter. And then when you take a look at that cost-cutting measure, I guess, how much of that do you think is the reason why we're seeing, look at that, the stock now up just over 7%?
Yeah, no, I think certainly the cost-cutting helps, right? I think that one of the concerns is that Intel's over-investing. I do think they have to invest to catch up. But having said that, it seems like they're investing everywhere, maybe in terms of reducing headcount in some places where there isn't quite so bright a future. That's the right thing to do. Also, if you look at their capital expenditures, those came down by $2 billion. So free cash flow won't be quite as bad as it would have been had they not cut CapEx. And so that certainly could help. And again, expectations were rock bottom heading into this quarter, given how difficult time Intel's peers and other suppliers into the server and PC markets have had this past quarter.
Certainly seeing that PC slump there, sales down 15% overall in the industry. You're talking about their peers. NVIDIA said those Chinese chip restrictions should cost some $400 million. How do you expect that to impact Intel?
So as of right now, it's not clear. Certainly Intel is struggling with the fact, and everyone's struggling with the fact that the Chinese consumer is a whole lot weaker than anyone would have anticipated 3, 6, 9, 12 months ago. But in terms of the enterprise side of things, Commerce has not really targeted server chips yet. I think that's where the risk is to Intel. Having said that, again, even the Chinese data centers, cloud providers haven't been spending as much. And again, I see that weighing on Intel the same as it's weighing on AMD, NVIDIA, and everyone else.
Matt, what would make you a little bit more positive on Intel, on the name, as you look out into 2023?
So I think 2023 is going to be a rough time for Intel, almost no matter what they do, in the sense that I think AMD's ahead in terms of transitioning to the next server CPU. On the PC side, it's a rough PC market out there. There's not much they can do about those two factors at this point. What would get me more positive is all of their struggles have really come down to issues on the manufacturing side. And so if they're able to put out more concrete details around how Intel's transforming itself to get their manufacturing back up to speed, parallel with that of TSM, that would make me feel a whole lot better about the story going forward. And so it's not so much for me about 2023. It's what does 2024 look like? What does 2025 look like? And right now, I just don't have the visibility to say Intel's fixed a manufacturing problem. So yeah, 23 might be a bad year, but you're not investing for 23. You're investing for Intel to be the best provider of server CPUs, PC CPUs in the world.
Part of the reason they'll spend that $20 billion on that Ohio factory. Shocking to see they lose half their market cap year to date. So what's the one thing that could reassure you that you could hear from Pat Gelsinger in the call upcoming?
I think the one thing I'll be looking for is on the PC side of things. I was a little bit surprised that the business actually grew Q3 from Q2. And so I guess one of the details I'll be looking for is that wasn't them pulling in some business, and that PC rebound is something that that will have a bit more in terms of legs for them, and that I don't have to worry about there being a bit of excess inventory out there, because again, everyone else you look at had a really, really difficult Q3 in PCs.
Certainly did. All right, Matt Bryson, great to have you. Thanks so much for joining us again. Intel shares popping in after hours, up just around 7%. All right, coming up, we're waiting on earnings now out from Apple, due out any moment. You can see the stock reacting to the earnings that we actually got from Amazon. So here it is ahead of those results, off just around 2%. We'll get analyst reaction as soon as it breaks. Plus, President Biden catching plenty of heat for high inflation. Find out how one decision he made could come back to haunt Democrats in the midterms. Stay tuned.
President Biden catching the blame for high inflation that's wrecking family budgets. But the question remains, could the president have done something differently? Yahoo Finance's senior columnist Rick Newman here to tell us. Rick, what could he have done?
So I think 2 weeks from now, when the midterm elections are over, I think we're going to have a lot of recriminations among Democrats about what they could have done better or differently leading up to the midterms, because they're probably going to get shellacked. And the Harvard economist Ken Rogoff wrote something in Foreign Affairs that caught my eye. He goes back to the decision to reappoint Jerome Powell as chair of the Fed. And, you know, this decision was underway at the White House in the summer of 2021. And Biden did not choose Powell. And if you go back to then, there was a chance that Lael Brainerd, who's now the Fed vice chair, she could have gotten the job. Biden could have recast the central bank. So he didn't make that decision to reappoint Powell until November of last year. He could have done that sooner. And this gets to the question of why the Fed seems to have waited so long to raise interest rates. They did not start raising rates until March of this year, when inflation was already at 8%. And if you go back to the summer of 21, when Biden was trying to decide who should run the Fed, inflation was already hitting 5 and 6%, so well above the Fed's target at that point. And Rogoff in Foreign Affairs basically speculates that The Fed under Jay Powell did not start raising rates at that point last year, mainly because Jay Powell was campaigning to keep his job. And, presidents don't usually like higher interest rates. Biden's not the only one. So the theory here is that the Fed under Powell actually delayed raising rates because Powell was waiting to see if he would get reappointed. Now, Powell is never going to tell us if that's actually true, and I don't think reporters will even ask him about it. But let's say that had happened. Maybe the Fed had started raising rates sooner and inflation would be lower than 8.2% at this point. It's a counterfactual. We're not going to know, but it's an interesting theory.
Yeah, they were certainly behind the curve. I thought you were going to say the Biden administration could have spent less money. That is certainly the other criticism out there. How might that have helped?
That is the Republicans' main criticism, and we're talking about not the Inflation Reduction Act so much, which has passed but hasn't really gone into effect yet, but the huge stimulus bill from early 2021, which Biden championed and then signed. And we now know that was probably way more fiscal stimulus than necessary. So we got more fiscal stimulus than we needed. We got more monetary stimulus than we needed. And that is why we have inflation now. Now, a year ago, we were still in this debate of is inflation transitory or is it going to be lasting? And we know now it wasn't transitory. It was fairly lasting. And this is probably the biggest factor that's dogging Democrats in the last few days before the midterm election. So they're going to have to live with their decisions from 2021.
Indeed they are. Check out Rick Newman's piece on Yahoo Finance today. Good to see you, sir. Thank you.
Bye, Dave.
All right, another day, another sign of weakness in the crypto industry. Crypto stocks down around 55% year to date, and today's shares of crypto mining operator Core Scientific down, let me check, down 78% over solvency concerns, a wipeout. Yahoo Finance's David Hollerith has the details. David.
Core Scientific said in an SEC filing today that it's not going to meet its debt payments for October and November. The company said it's exploring a number of alternative capital structure options to meet debt eventually, but also noted that this could include filing for bankruptcy, in which case stockholders would be out of luck. The context here is that Bitcoin mining companies typically take a lot of capital expenditures up front, and that's to pay for equipment, mining facilities, and this consistently high power draw that they need to power their machines. And those expenditures have been much tougher to meet in recent months for Core. And part of that comes down to the fact that the company's daily revenue is getting squeezed on both sides by both a higher electricity prices, and then on the other hand, a lower Bitcoin price, which means what they're earning is costing less, if that makes sense.
It does indeed. David Hollerith, unfortunately, got to leave it there. Got some breaking news coming in. Thank you, sir. Shauna.
All right, let's take a look at Apple shares extending those earlier losses. You can see, oh, look at that. Now it was off just around 4%, now off just around 1%. Jared Blickery has the numbers for us. Jared, what's going on?
Yes, easy come, easy go. Let's get to those fourth quarter results. Revenue beating street estimates, coming in at $90.15 billion. That is up 8% year over year. Estimate was for lower, $88.64 billion. And then when we break this down by segment, iPhone revenue, that was a slight miss. You could almost call it in line, $42.63 billion. Street estimating $42.67 billion. That's up 9.7% year over year. Mac revenue beating handily, $11.51 billion. That's about $2 billion over the street estimate. iPad revenue coming in a bit light, $7.17 billion versus estimates of $7.81 billion. And then wearables, $9.65 billion. That's up 9.8% year over year. And that is about $1 billion higher, just a little bit less than that, than the street estimate of $8.8 billion. Now, let's take a look at service revenue. That came in at $19.19 billion, and that was less than the street estimate of $19.97 billion, still up 5% year over year. And now here's another key stat, Greater China revenue. $15.47 billion, that is lighter than the estimates of $15.65 billion. And then finally, EPS, that's $1.29 coming in versus the estimates of $1.26. So beat the street number by 3 cents. Oh, I do have a couple more numbers here. Gross margin, $38.1 billion. That beats the estimate of $37.31 billion. And then here's a miss that people might fixate on for a little bit. Cash and cash equivalents coming in at $23.65 billion. That's about $4 billion light of the estimate of 27.63 billion. Not that Apple needs any more cash on its balance sheet, but it is interesting that that declined 32% year over year. So overall, Apple was already down 2% based on those Amazon results. So it's actually up a little bit since then. We'll have to see what comes on the call, guys.
Yeah, Jared, all eyes are going to be on that call. Again, I guess when you stack Apple up against some of the other tech giants, these numbers look pretty good, which is probably why the losses that we're seeing after hours aren't that significant. Again, just barely in the red, now off just around 1.5%. So bumping around just a little bit. When you take a look at that China number, obviously that was a huge focus here. International sales, that coming in a bit light, 15.47 billion. Estimate out there, Dave, was for 15.7 billion. iPhone revenue, we know that's so critical for the company. Like Jared said, that coming in just a bit light. So I think that analysts are just kind of trying to digest these numbers when you take a look at maybe some of that slowing growth there and what that could mean for the company in this very important holiday sale quarter.
You could argue you thought shares would fall bigger, being that all three areas, they were being watched here, really. iPhone demand, we saw a slight miss there. Services, a miss there. And China. So those are really the three biggest areas. And still, shares, down, but not terrible at 1.7%. Already some comments to CNBC from Tim Cook that says, they would have grown double digits if not for the strong dollar. Talked a lot about FX. Quote, the foreign exchange headwinds were over 600 basis points for the quarter. It was significant. We would have grown in double digits without foreign exchange headwinds. So again, not terrible, but certainly not what you've come to expect from Apple, and really just reflects a larger bad macro environment for all of big tech at this juncture.
It does. It certainly does. Really highlights the strong dollar, what that's doing here for so many multinational companies. When you take a look, though, of the fact that Apple did report that its active install base of devices reaching an all-time high, their CFO making some comments saying that the strength of our ecosystem, unmatched customer loyalty, record sales, spurring that number to get devices to that new all-time high. But again, not enough here. When you take a look at that iPhone number, shares off just around 1% in after hours.
All right, coming up, we see the Apple shares moving down just 1% at this hour. After hours, we'll take a closer look at the fourth quarter earnings, break them down for you next.
Apple turning positive. Look at that here. After hours revenue coming in better than expected, up 8% year over year, $90.15 billion. iPhone revenue coming in just a bit light, $42.63 billion. Street was looking for $42.67 billion, so just missing Wall Street's expectations. Here to break down the report, we want to bring in Ivan Feinseth, the Tigris Financial Partners Chief Investment Officer. So Ivan, when you take a look at the after hours action, we've been bouncing around just a bit. We were off 4%. Now we're back in negative territory, off just around 0.5%. What's your initial reaction to this report?
It was a great quarter. I mean, yes, it missed slightly in some areas, but the macro environment's tough. So to do the job they've done in this quarter is very good. And, FX has been a significant headwind. And unfortunately, sometimes foreign exchange is a headwind. Sometimes it's a tailwind. It's been a massive tailwind. But most importantly, the iPhone 14 was only available to ship in the last week of the quarter. And they could have shipped more, but they also face supply chain constraints. So they are not able to build the number that they need to. So the demand is strong. And the slight misses in this environment, I think, makes it an incredible quarter. And I think any weakness is a major buying opportunity.
So all the concerns over waning I-14 demand issues, you think much ado about nothing when you look at this report?
Absolutely. I mean, they really, they missed by, less than a percentage point in most areas. It was just so small. And given in this environment, it's a phenomenal job. And the demand is there. And key, while the services revenue, again, slightly weaker, it's about growing the ecosystem and expanding the services base. And they also just announced a services increase for Apple TV, the Apple Plus bundle, Apple Music, and several of those services by $1 to $2 a month, which, based on their massive user base, is a significant amount of money. Not that significant to the consumer, but certainly very significant in the aggregate for Apple, which kicks in, next quarter. Yeah. So there's a lot of wind at their back.
Yeah, Ivan, I wanted to ask you a little bit more about that bump up in price, what that would mean for Apple in the current quarter. Well, I guess more so looking out to 2023. You mentioned it will boost their revenue. I guess by how much is the question. What are you forecasting?
I don't have the number. They have, I think, 800 million active users. Mm-hmm. And so by $1 or $2 a month, you multiply that out, and that's a lot of money. I mean, it's, let's say it's $1 billion, another $1 billion a month remember that this incremental price increase is mostly profit. I mean, I'm sure costs have increased, and certainly in the case of Apple TV, the cost to produce content has gone up, and the need to pay people more has gone up, but the incremental increase to revenue is much more significant than the incremental increase in cost. So it is a net positive, and they still offer a great value. And Apple has a very loyal customer base, and they are still a long way into a massive upgrade cycle. There are a lot of people with iPhone. I know people with iPhone 8s, but certainly there are a lot of people with older iPhones that will be, 1 to 2 years into their contract that will be eligible to upgrade next year. So this upgrade cycle is pretty powerful. And the other important thing to remember that demand is strongest for the more expensive phones. So consumers want the Pro and the Plus and the more expensive phones because consumers are willing to pay up for phones, for smartphones, and for the service because it's such an integral part of people's personal and professional lives.
Yeah, the demand all on the Pro side. Another question coming in was the impact of the China COVID lockdowns. Ivan, what are we seeing there? Are you able to take away anything from that?
Well, they did report strong China results, but China has been under they have this zero COVID policy. They locked down right away, and it has been disruptive to companies that do business in China as well as China's own economy. But, eventually, hopefully the COVID issues will subside, and then the economy there will pick up. So I think Apple is in a great position. The stock has been down, and I think it's a buying opportunity here. And I always say any weakness in Apple is a buying opportunity, and history has shown that to be the case.
Yeah, no guidance since 2020. So what are your biggest lingering questions for the call?
Well, I think the most interesting thing, especially with what's gone on with Meta platforms, is that the anticipation of an introduction of a virtual reality headset from Apple and what that looks like and how that integrates also into their services revenue, because they already have a operating system for their virtual headsets that has been launched, and they also launched tools for developers to start to make content for that. So we have a whole nother wave that is very fascinating of additional potential sale of hardware and software and services. So there's still a lot of exciting things ahead. And the fact that the wearables market continues to grow with the new launch of the Apple Watch, the Apple Ultra Watch, and the new AirPods. Again, there's a huge upgrade cycle for that. And that is already proving out.
So overall, Ivan, it's been a gloom and doom story in tech, no secret there. But what does this report tell you about the environment as a whole, the macro environment and the headwinds?
It still exists. It's a tough environment, but yet Apple, I think, is enduring pretty well. So to have these just tiny shortfalls from expectations that are almost insignificant is a major positive.
Chalk it up for another W for Mr. Cook. Ivan Feinstein, good to have you, sir. Thank you. All right, let's get it over to Shauna for what's moving after hours. Hey there.
All right, Dave, we were just talking about Apple. We also have Amazon, Intel, Pinterest, and Deckers. Let's kick it off with Apple. I know we just reviewed it real quick, but taking a look at this reaction after hours, now back in negative territory, off just around 1%. Revenue coming in better than what the street was expecting at $90.15 billion. That's up 8% year over year. iPhone revenue coming in just a bit light, $42.63 billion. Street was looking for $42.67 billion, so just a small miss there. Strong dollar obviously cited as a headwind here in Apple's most recent quarter. Active install bases of devices hitting an all-time high. Very important here. Over the past 3 months, you can see Apple's off just around 7.5% year to date. Stock off around 18%. Let's take a look at Amazon. Very different story here after hours. The stock selling off just around 17.5%. It did hit the lowest level that we have seen Amazon trade at since March 2020, earlier in after-hours trading, shortly after these earnings were just announced. AWS revenue missing guidance for the fourth quarter, the current quarter, holiday sales quarter, coming in just a bit light. That's a big reason why we're seeing the stock take such a significant hit here after hours. Fourth quarter guidance, $140 billion to $148 billion. The street was looking for $155 billion. Taking a look at Intel, that's actually moving to the upside. You can see it up just around 6% in after hours. Revenue coming in a bit light. EPS did come in better than expected at 59 cents. Estimate was for 33 cents. I think a big reason why we're seeing this pop after hours has to do with the cost-cutting measures that was just announced from the company. And that includes they're looking to cut costs by $3 billion next year in 2023. Fourth quarter guidance also coming in just a bit light. But again, that move after hours, a lot of that coming with the cost-cutting measures that Intel has just announced. Taking a look at Pinterest, that stock popping here, soaring after hours, up just around 15%. They beat on revenue, beat on adjusted EPS. Revenue coming in $685 million, adjusted EPS of 11 cents. Monthly active users, 445 million, the estimate on the street. 440 million. Year to date, the stock off just around 39%. Over the past 3 months, we've actually seen gains in Pinterest up just around 14%. And taking a look at Deckers as we round out these after hours movers here, off just around 8.5%. A lot of that has to do with the guidance that we just got from the company. They maintained their full year net sales forecast, but that came in lower than what the street was hoping to hear. EPS beat sales $876 million for the most recent quarter. The street was looking for $805 million. Over the past 3 months, Deckers has actually outperformed by a wide margin, up just around 27%. Year to date, though, a bit of a different picture. You can see it just in the red, off about 2%. So, Dave, comparing that to what we've seen play out in the broader markets, it's actually been an outperformer.
Yeah, climbing out of a deep hole. Shauna, thank you. Good stuff. My stock to watch for Friday's an energy twofer. Exxon, Chevron, both reporting Q3 earnings tomorrow, and that's before the open. Chevron turned in record earnings in Q2. The consensus EPS estimate calls for Chevron at $2.96 and revenue of $61.44 billion. Astounding, isn't it? Exxon, meanwhile, has an EPS estimate of $3.80 on revenue of $102.96 billion. Jefferies earlier this month upgraded the stock to buy from hold As for oil prices, on the move ahead of the report, WTI up less than 1% to 88.55 per barrel. Brent also up less than 1%, 96.53. All right, coming up right here, if you're feeling lucky, then Saturday could be your day. Find out how big the Powerball jackpot has climbed next.
If you're feeling lucky, you want to head out there and go get your Powerball ticket. The Powerball jackpot now sitting at $800 million. It's the second largest Powerball prize and fifth largest overall U.S. jackpot of all time. The next drawing is Saturday, and if the lucky winner picks the cash option, which most people do, they could walk away with $383.7 million after taxes. Not a bad winning there. Are you going to do it?
I'm of course going to play just
Do you
so I
always
can
play?
envision the boat. And yeah, it's just the yacht. It's worth it to me to dream
I'm
about
with
my
you.
yacht. Are
I'm
you going to play?
Yeah, of course.
Please do.
I will. Maybe we'll do a team thing.
Little team thing.
All right, I like
that. Okay, because we're never coming to work again. Sorry, guys. All right, if you win that $800 million jackpot, we've got just the holiday catalog for you. Neiman Marcus out with this annual fantasy gifts guide, and there are some eye-popping gifts here. We're talking about a $3.2 million Cartier tiara or a $333,000 basketball game. You get to play, of course, with no ordinary player. You join former Chicago Bulls star Scottie Pippen. That is quite the giveaway there. Shauna, you went through this catalog. What do you want from me when I win the $800 million?
What do I want you to pick?
What do you want me to buy you?
Oh, to buy me. Okay.
Yes.
I would like you to buy $295,000 Polo Aspen experience. I have never played polo. I always thought it looked really cool. It's way too fancy for me, but if I'm winning the lottery, I'll be spending $295,000 maybe on this. When you take a look, it includes one-on-one lessons with 2 polo champions, 2-night stay at the St. Regis. You get to bring 11 friends. Not too shabby.
11. Do I make the cut?
Yeah, you'll make the cut.
I appreciate that.
Of course. The more the merrier. What about you?
Well, you know, I'm a sports guy, so mini golf, custom mini golf course in your backyard, 200 grand seems.
There's no way. I was actually waiting to see if you were going to pick this. I thought you were going to do it given your sports background, but no, there's a much better one, and I think we have it ready for you. Barbiecore. You love Barbiecore. You're trying to convince your wife that you guys could dress up as Ken and Barbie for Halloween. She rejected it. This Maserati, I think, has your name all over it.
I look good in that Maserati, right?
You
really
do.
highlights my pink nail polish, perhaps. 300 grand, I think that is. I'll get you the diamond tiara just for kicks.
Oh,
okay?
thanks. So sweet of you. All right. Well, that does it for us today on Yahoo Finance. There we go. We'll leave you with that. $3.2 million. That's incredible. All right. Well, that does it for us today on Yahoo Finance. Thanks so much for tuning in. We'll see you right back here again tomorrow. Have a good night.